In 2021, the global commercial aviation industry abruptly halted. The world's busiest airports fell completely silent as international travel came to a sudden standstill. In Australia, widespread domestic lockdowns defined the first half of the 2021 to 2022 financial year, grounding fleets and crushing revenue streams. Despite planes sitting idle and borders remaining tightly closed, the Qantas Group proceeded with its annual executive performance evaluation. Evaluating performance during a crisis measures how effectively leadership manages systemic bleeding. When the Qantas Group finalized their 2021-2022 performance scorecard, the mathematical outcome was a 90% executive payout. This payout was calculated under the STIP, or Short-Term Incentive Plan. This is an annual opportunity where executives receive a combination of cash bonuses and restricted shares for hitting highly specific performance conditions. A corporate board justifying a 90% incentive payout while the primary business operation is effectively illegal to conduct presents a stark and profound mathematical paradox. This table recreates the actual Qantas STIP scorecard. To understand the board's decision, we have to look past the top-line number and dissect the specific weightings and individual components. The scorecard calculates individual outcomes against a maximum possibility of 150%. It scales the final achievement to a standard 100% baseline, resulting in that 90% achievement mark. Flat percentages obscure the underlying mechanics. To see exactly how that score was built, we must isolate the purely financial targets from the daily operational realities. Let's start with group financial measures. Underlying earnings before interest, tax, depreciation, and amortization, EBITDA, carried a 30% weight on this scorecard. Because of the lockdowns, earnings fell below the board's threshold, resulting in a zero contribution to the STIP. Compare that to Qantas Loyalty, which carried a 20% weight. Executives executed recovery plan initiatives, delivering $923 million in structural cost benefits, allowing the loyalty division to exceed its earnings target. Additionally, metrics for leading domestic market position and workplace safety exceeded their targets, carrying the overall mathematical score upward. Heavy internal weightings focused on structural recovery and operational safety overpowered the external financial losses on the balance sheet. There is an anomaly in the customer category, which carried a 15% weighting. The specific target for external reputation and trust was exceeded. In a formulaic system, that would trigger an automatic payout. But executive compensation often demands human intervention when rigid financial formulas clash with operational reality. Despite high trust scores, brawler punctuality and net promoter scores plummeted. Customer satisfaction fell well below the threshold due to operational chaos at the airports. Acknowledging this reality, the Qantas board exercised deliberate discretion. They manually overrode the formula to record zero achievement for the entire customer category. Pure numbers alone do not dictate strategic payouts. True performance management demands that metrics are continuously aligned with actual operational conditions. How does a company logically assign these specific weights to competing financial and operational metrics? In 1989, researchers F. Cross and R. L. Lynch published the Strategic Measurement Analysis and Reporting Technique, or SMART framework. This diagram is the SMART framework, known in corporate strategy as the performance pyramid. Notice the division at its base. The pyramid explicitly splits into two complementary halves, external effectiveness on the left and internal efficiency on the right. Unlike older frameworks, the pyramid establishes a direct link showing how external market positioning relies on internal productivity. It is an analytical engine, proving that non-financial measures must be integrated to drive financial outcomes. Let's track the logic downward. Level 1 is corporate vision, dictating how long-term success and competitive advantage will be attained. At level 2, business units split that vision into initial critical success factors, specifically in the market and financial domains. We drop to level 3, business operating systems. Here, market and financial goals dictate strategic objectives for customer satisfaction, flexibility, and productivity. Finally, level 4 is the operational foundation, running daily status checks measured by quality, delivery, cycle time, and waste. Think of a synchronized industrial operation, like an automated baggage routing system. That represents the ground-level efforts to reduce cycle time and eliminate waste. The framework connects vertically. Improving ground floor cycle time at level 4 increases systemic productivity at level 3, which in turn satisfies the financial EBITDA targets at level 2. This hierarchy links top-floor financial visions directly to ground-floor operational execution. Why should modern corporate boards utilize the performance pyramid instead of the balanced scorecard? While both frameworks combine financial and non-financial metrics, the balanced scorecard operates as a flat matrix. The pyramid's comparative advantage is its hierarchy. It requires senior managers to set and cascade objectives tailored precisely for each specific corporate level. Because it is adaptable, managers at every level know exactly how their daily metrics roll up to support the broader corporate strategy. A flat scorecard evaluates past performance. A hierarchical pyramid dictates future execution. Despite its structural logic, the performance pyramid contains a significant limitation. Like any rigid structure, it is vulnerable to unseen pressure. The performance pyramid concentrates its architecture on only two categories of stakeholders, the shareholder and the customer. It ignores the expectations and contributions of the employees, the suppliers, and broader society. To resolve this, modern strategy relies on the performance prism model, which addresses the flaw by placing the expectations of all stakeholders at the core of the system. Neglecting the expectations and contributions of the workforce or the supply chain creates friction that shareholder-only models cannot account for. Let's lock in the mechanics of strategic cost and performance management. First, the STIP calculation. Actual achievement, multiplied by category weighting, adjusted by board discretion, determines the final payout. Second, the performance pyramid flow. The corporate vision at level 1 dictates the financials at level 2, which require the productivity at level 3, driven by reduced cycle time at level 4. And finally, the limitation. The pyramid serves two stakeholders. The performance prism serves all stakeholders. Whether surviving a pandemic lockdown or planning a decade of growth, corporate survival requires knowing exactly which operational levers control the financial ceiling.